I often speak about the geopolitical risk that appears to be intensifying about every day, but I believe this is justified by the situation. We had Ukraine and now the Israel conflict that is extending through the Middle East with Yemen and Iran. These are times of crisis when emotions often run high, as much on social media as in financial markets. Interestingly, it shows who is in control versus who is not. Fear, panic, and uncertainty can lead to impulsive decision-making, which may not always be rational or well-informed, such as an aggressive message or a compulsive trade. The one trade that you do not because you know what to do, but the trade that you do because your brain is wired to do something in a situation of danger. If one lets his emotion master his mind, one can see the forest for the trees, which almost always lead to very poor decisions. Trading is a mental exercise, and to focus on what we can control, there is a fantastic tool in the investment world. This is systematic quantitative trading. And systematic quantitative trading can be an invaluable tool in crisis situations by providing a disciplined and emotion-controlled approach, which is to me the most stoic way to invest in the markets. Systematic quantitative trading has many advantages, in my opinion, and I will mention three, specifically in the context of money management during crisis. First, emotion-free and discipline in decision-making. Quantitative trading systems operate based on predefined rules and algorithms. They don't experience fear, panic, or other emotional responses to market events. Quant trading systems react to what is actually happening in the markets and the data, when volatility and rapid price movements may lead to heightened level of stress and overreaction, eventually leading to poor investment decisions. Under stress, the beautiful investment thesis is often thrown by the windows in seconds, when quant investment trading brings the necessary discipline in periods of market turbulences. Second, adaptive and consistent risk management without panic. One key element of a quantitative trading system is global risk management and the allocation of risk between its components in the context of a portfolio rather than a collection of individual positions. Systematic trading models and risk management in particular can be designed to adapt to changing market conditions without succumbing to panic. Algorithm can automatically manage exposure and adjust risk allocation to keep a risk control and risk balance portfolio with a rational response to rapidly evolving crises. Third, hypothesis testing. The market has mostly been heavily sedated since the great financial crisis in 2008 and the massive injection of liquidity that generated the everything bubble that the Fed now tries desperately to keep from imploding. Fortunately for those who never experience a real crisis, quantitative strategies offer the opportunity to test hypotheses of system responses specifically to market crises. By using extensive historical datasets, backtests allow me as an investment manager to understand how the strategy may have performed in past crises. This gives a crucial historical perspective that can instill confidence and reduce the emotional impact of managing assets in crisis. Systematic quantitative trading provides these types of benefits, but it's essential to recognize that a thoughtful combination of quantitative model, risk management practices, and a comprehensive understanding of market dynamics are necessary to successful trading during crisis. Both investment managers and investors should be aware of the limitations of their models because they are never perfect and continuously refine them based on evolving market conditions. Evolution, adaptation, and risk control are the keys to success in investment management, specifically in troubled times. Thank you. Bye-bye. See you next week.